Hello, 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 and happy Thursday. Thank you for tuning in for yet another live event where we unpack current news on the multifamily market as well as multifamily underwriting one step at a time. So, I decided to do a quick pop up live today on a topic I've been discussing quite frequently as of late with a number of investors, and namely why I continue to invest in multifamily despite the headlines that we're all reading today. But before I share my thoughts on the topic, for those who may be tuning in for the first time, my name is Vessi Kapulian. I'm a former commercial lender turned real estate investor. Today, I work both with active and passive investors, specifically high achieving professional business owners, family offices, where I help connect them to well vetted opportunities, investment opportunities in apartments. And I also advise active and passive investors on the complexities of deal structure, the numbers, and various aspects of the offering. And for those willing to do a deeper dive, I lead a community that comes with a self paced course where we do a deeper dive in multifamily underwriting. Speaking of which, before I forget, I did want to share with you that next Thursday, August 14th, I will be hosting a masterclass, a free masterclass, where I will share with you my blueprint for underwriting multifamily deals and how that has evolved in the current market space. So you can register via the link below, which I will post in the comments once this live event is complete. But without further ado, there are really 5 reasons that continue to keep me optimistic about the long-term state of multifamily market. Factor number one is supply and demand dynamics that are continuing to shift in favor for the long-term growth of the sector. Specifically, almost any report that you read, whether it's a Yardi, CoStar, RealPage, a lot of the broker sites, they're all confirming one common trend that even though completions remain elevated this year for projects that were started a year, 2 or 3 years ago, there is a pretty steep drop off in starts. And that's for a variety of reasons, where the top line in terms of rents has flattened out. The cost of construction has gone up, labor, materials, including the cost of borrowing. So very challenging for new developers to get the projects to pencil out. Again, this is more a general statement at a national level. There are, of course, new construction projects that are getting started and permitted for daily in markets, submarkets, and pockets where it makes sense. But the trends that I'm referencing to are more at the national level, and as we know, multifamily is hyper local. On the demand side, we have affordability constraints because of where, for those looking to buy, right, because of where prices have been. And while the single family growth price level has slowed down year over year, it is still positive. For people to get a mortgage today, based on today's rates, costs almost twice as much versus what they would have paid before the rates started going up. And the average gap, right, between rent to own, rent versus own, depending on which source you reference, is anywhere from $1,000 to $1,500, which is pretty sizable. So, for better or worse, that's keeping people in the rental market for longer, and it's delaying the home buying for many young professionals. And so the demand hasn't for renting for rent hasn't really slowed down. Again, in some markets, that's stronger than others. So that supply demand imbalance will create opportunities for price inflation when it comes to rent, unless new construction starts coming on the market soon. In a couple of years, we'll be in a situation where we'll have limited supply and ongoing demand. Now, there's some headwinds that may come up. There's a lot of talk about a recession and jobs, and that can, of course, have an adverse impact on not only the homeowner but also the tenant or the rental market as well. So that remains to be seen, and that's certainly something that I'm watching very closely. And if you're interested to take a sneak peek into some of the leading economic indicators I'm keeping an eye on, send me a direct message and we can connect, and I'll share those resources with you. Number two, which I alluded to a little bit a minute ago, is the rent inflation that's on the horizon due to the demand and supply mismatch. Again, very costly to build brand new apartments today. In some jurisdictions, the permitting is even more burdensome. So, very difficult for deals to pencil out, which will bode well for the rental markets. Now, uh, reason number three, and why I historically have liked multifamily, but even more so today, is that relative to other asset classes on a risk adjusted basis, multifamily still ranks among the lowest, where the top contender tends to be industrial, followed by multifamily. And so, even though delinquencies have increased because we are at or near bottom, and I can share my thoughts on that as well, relative to other asset classes, those delinquencies rates are relatively low. And so we don't know where the bottom is, and that's my reason number four. But based on everything we're seeing, which is the rent compression, which is just now starting to flatten out, the supply demand just now is starting to even out and come to balance, which has helped with vacancies as well. Um, and cap rates hopefully are at their peak. We'll see a lot of it depends on that supply demand imbalance, rates, geopolitical events, and whatnot. But all else equal, a lot of that's at the peak. So numbers that are suggesting that if we're probably close to the bottom. Now, I did speak in my last live event about the huge wall of maturities, and so depending on how that gets resolved, things may get better or they may get worse from where we're at today, which is why I'm not quite sure if we've hit rock bottom yet. But again, as investors, we don't look to necessarily time the market. That's gambling and pure speculation. And if that's what you're trying to do, maybe don't invest. Do something else. And number five, so we talked about supply and demand, the rent inflation, the risk-adjusted basis relative to other classes, the fact that we're at or near bottom. And then reason number five is my personal moodometer, right? I look at the level of enthusiasm, and most multifamily investors today are jumping ship. A lot of my peers are going into other asset classes, buying businesses and whatnot. So for me, that's also a good indicator that it's probably a good time to buy. Again, not at any cost, and as long as the numbers, operator, and the market make sense. But that's what my moodometer is telling me. I see a lot of people chasing shiny objects, chasing waterfalls, which may dry up before it's too late. So I'm personally choosing to hold my ground and stay in my lane. And that's what I believe also helps me be a subject matter expert and a better advocate for my investors. With that said, if you do want to learn more or be part of future live events, you can follow me on LinkedIn as well as YouTube, where I go live on a weekly basis. And if you subscribe to my YouTube channel, you will be notified of those future live events so you don't miss out on any of those. And if you are looking to do a deeper dive into underwriting multifamily properties, so you can analyze those investment opportunities coming your way with clarity and ease, and hopefully avoid all the overwhelm and confusion, I'd like to invite you to my complimentary master class next week on August 14th at 5 p.m. Pacific. A link will be posted in the comments below. And I know you will get at least one takeaway that will serve you in your underwriting and investing journey so you can make savvy investment decisions, minimize the risk of loss, and be an educated and empowered investor. I appreciate you. Thank you for tuning in and joining today. And I will see you next week. Ciao.